All right, so let's start with tests. Tests are very valuable, but they pop up all the time. And again, I emphasize this and re-emphasize this over and over. But the key thing is that when they show up, they have to be in the right place. You have to look at structure. You have to look at the context and the background. Just because a test bar comes into place doesn't necessarily mean much of anything. But when it comes into place after a sign of strength, like a 2-bar bottom reversal or a selling climax, then it has much more meaning. All right. So typically they're a down bar on reduced volume, and the range or the spread is going to be narrow. The key is always going to be the volume, and it should be less. A rule of thumb that Tom Williams uses, which is helpful, not critical but helpful, is that the volume should be less than the previous 2 bars. The market will close down from the previous close, so it's going to be down, but it's better when it closes on the middle or on the high. Okay, and again, it follows the sign of strength. There are different variations. We can have a test into an area of high supply, like stopping volume or a selling climax, or we can see tests coming in after some temporary weakness. Or we will see tests occur in a rising market. We often see them in a rising market, and they're pretty useful then. Okay, so let's look at some charts here. You can see that on this chart, this is a 5-minute chart of the diamonds, the ETF of the Dow Industrials. We were rising up, and we suddenly gap open one morning, and there's a big imbalance here between sellers and buyers, and we have that gap. And if we were to, one trick to use in gaps is just to extend. We would look at what we would call the true range of a bar. The true range in a gap situation is from the previous close to the current low in this case, and so we would extend a line down, and that would be our bar, if you will. Okay, so that's a pretty significant bar coming down on a true range basis, and it's a lot of supply that comes into the market. It's saying that there was something happened overnight to cause this market to fall. So the market falls on the open, and yet when we come back down and revisit that same area, we can see that the spread's narrow. There's a nice little test here. It's a down bar closing in the middle on fairly low volume compared to the volume that we saw previously here. The market rallies up a little bit, comes back down. Here's a lovely little test. I like it when I see this kind of a test. It's an inside bar. It's inside the range of the prior bar on very light volume. And here it's closing near its lows, but look at the market shoots right up after that. And then we have another little test here, and the market continues to rally up higher. Okay? So those are pretty good examples of a test bar or test bars in that particular situation. Here's a different look at tests. Here we have a market that had been rallying, and then we go into this long sideways trading range. And here's something that's actually kind of cool. Few people know about this, but when we come into a point of resistance like this, and we get a good test bar, as we do here, it's suggesting that there's resistance, but there's no supply here, and the market has a good chance of trying to rally up higher, which is what it does here. That's something to watch for. This, I guess we would call this a test in a rising market, but as it comes into a resistance level, and we get that testing action here on very low volume, you want to look and see what does the next bar do, and the bar after that. If it takes out the little resistance there, then you know that that was a nice little test, and this market has a chance to rally for, well, in this case, quite a bit. Okay. Trevor says it looks like it can be a 2-bar reversal as well. Well, we wouldn't see high volume. On this, we're coming down here, yes, and we would typically see fairly high volume on both of these bars here, and we don't really have that. I'm sorry, on this bar and this bar, we don't really have that here, so it's not really a bottom reversal. This is a test, and then the next bar dips underneath that, comes into this level here where high volume existed, found no further supply. If we saw this unfold real time, what we would see is on this bar there would be very little volume down here as we dipped underneath the prior low, and then most of this volume comes in on the rally. Okay, so but don't confuse it with a bottom reversal. Just it's a test, and that's the key thing. But it has that characteristic look of that bottom reversal in that case. But that doesn't mean that that's what we would see in terms of testing. Here we see another chart where we have some stopping volume coming in, and here's the thing. Here's the thing about tests, and that is that sometimes it takes more than just one test to complete the buying that has to take place before a market is ready to rally up. So here we have some stopping volume coming in. We'll talk a little bit about that a bit later, but high volume comes in, the market falls precipitously, and then we see some buying occur here. We see shortening of the thrust in the price bars. We see the prices closing firm. Only buying does that. It rallies up. We come back down. We test this. We come underneath the low here. We have that narrow range bar, a couple of them actually. Not quite down bars here, but it's testing nevertheless because it's coming back underneath this low. And the volume is not quite as high, but still have pretty high volume here. And so we rally up. This is actually more testing in here. We rally up again. There's what Wyckoff would call a terminal shakeout here, where we dip underneath a trading range, the lows of a trading range, rally back up, and then look at the classic tests that occur here and here. Very narrow spreads or ranges, very light volume, and it's in that same area as all this. Let me erase this. It's in the same area here as all of this other high volume that we see in here each time it comes down. And yet here we've got volume that's significantly less than what we saw here. So what that suggests is that the market gets marked down on down bars, or it gets pushed down, and no volume comes out. Okay. Here it gets pushed down and we get high volume. Here it gets pushed down, we get high volume. Here it gets pushed down and we see volume come out. Here it gets pushed down, we see volume come out. Here it pushes down and there's no volume. And it's after a terminal shakeout. So the context is set several times. 1, 2, 3, 4, big time. On 4 times it tried to go lower. Can't do it. it gets tested in here. The market is now on the springboard. Wyckoff would say that the market is now on the springboard to rally up and rally up well. And you can see that's what it does. And it's in the middle. A little apex gets formed, but more importantly, it's in the middle of the high volume areas throughout the trading range. You have to train yourself to look backwards in time, to look at the context of the market and see what happened earlier in this trading range. And earlier in this trading range, I'll just repeat it one more time, this is the area of high volume. And this is the level. If we were looking at this on a point and figure chart, this level here, this is Baidu, of around 240 or just under 240. That's the area of high volume. And this is Baidu on a daily basis. And that's where that testing occurs, puts the market on the springboard for a rally, and it rallies up. Now, notice what happens. We jump. This is a classic Wyckoff kind of a pattern, if you will, where we have some selling climax or stopping volume. In this case, it's stopping volume. We go into a trading range. It gets tested at the bottom of the range. We get that shakeout. We come onto the springboard. We have a sign of strength in its own right with this rapid rally on high volume. Everybody can see that, right? Strong move up on good volume. Strong move meaning that buyers are stepping in and they're reaching up to buy here. We know that by the width of the ranges or the spreads. Okay, and we can compare that to other spreads. But more important, or just as important, we drive up above the level of supply. We see supply here come in, here, here, and here. So you can draw a little line across of supply. Okay, we tend to use straight lines, but in the Wyckoff tradition, we actually will use a curved line, just kind of highlighting the area of supply where it came in. And so this is called jumping across the creek, this strength here, this sign of strength. We call it a jump across the creek. The creek being the river or creek of stream of supply that exists along these points. And Bob Evans, who owned and Wyckoff Associates after Wyckoff died, was very good about creating little metaphors or stories to describe market actions. And he talked about a Boy Scout, and he was talking in the 1940s and early 50s when in the U.S. the post-World War II baby boom generation, kids were Cub Scouts and Boy Scouts. So Boy Scouts were a popular thing. Everybody knew, what a Boy Scout was and had experience with it. Just about everybody did. And here was a Boy Scout who wanted to get to some destination over here, and he's down here, and there's a creek or a river, and he's looking for a place to jump across, to get across that creek so he can reach his destination. He comes up to this point, but it's too wide. The river is too big here. Too much supply, if you will, to be able to push across that creek. So he comes down. He comes back up to the creek. It's still too wide. Comes up here, still wide, but now it's narrowing down. So he figures if I can get a running start, and he backs way up over here and then takes a good, strong running start and jumps across that creek. And that's the sign of strength here, where the creek narrows down. And with some volume and some wider spread, the market can drive across that creek of supply or that level of supply. And then the Boy Scout's done a lot of work, and before he goes on to his destination, he decides to come back up to the edge of the creek, take his boots off, cool his feet in the water of the stream, and then go on to his destination. Okay, and that back up to the edge of the creek right in here is a testing process to make sure that there is, in fact, no more supply. Because on this drive through, there's high volume and widespread, lots of activity, buying overcoming demand overcoming supply, but still a lot of supply, and we know that because of the high volume, so it must be tested. And that's what we look for. We look for a testing to occur here, and we see that that volume dries up on the test. Okay? So this is jump across the creek, and you can see the nice testing that occurs in here. There are a few bars. There's one particular bar here that we would call classic testing, but just in general, as we come back, notice how the spreads or the ranges are narrow compared to this, where the ranges are wide. Look at the volume, high volume here. As we come back, volume recedes, and it comes right back to the top of the trading range, the top of the creek, and that's what we call a backup to the edge of the creek. It is a prime or choice long side trading opportunity. When we have all of these things in place, stopping volume or selling climax, testing that occurs, doesn't have to have this terminal shakeout. Sometimes it's a spring, sometimes it's not. Sometimes they hold higher lows. But this sign of strength, or this jump across the creek, is a key component. So we want to see that stopping volume or selling climax. We want to see it test a number of times. And there's no magic number. I don't know if it's 2, 3, 10. It's some number of times. And then we see that jump across the creek, and then the backup to the edge of the creek is the choice trade location. We see that all the time in the markets. First described back in the 1940s, the late 1940s, and we are now 50 some odd years later, and we can go tour through a number of charts and see that indeed we will see that kind of testing in this jump across the creek type of pattern. So far in this course, you've gotten two classic patterns from the Wyckoff playbook. We've had the Shell Divers Tragedy, which looks at wave structure, and we've had now jump across the creek. Let's just take a look at this in a little bit more detail. Now, in terms of wave structure, we have this creek of supply that comes through, and I'm going to change the colors here just so we can see hopefully I can change the color, yeah. You can see big down wave. Sellers are in control. An up wave. Pretty good size down wave. Sellers still in control. An up wave. Now look at how the selling waves start to diminish, right? We push underneath and then we rally back up, and now for the first time we see a bigger down wave, a bigger up wave than we've seen in quite some time. Change of behavior, sign of strength, jump across the creek. Call it what you like. It doesn't matter what we name it. Just be able to see the structural change in this market. And then we come back on a small wave with testing pattern at the point where supply had existed earlier. And this is another principle. Where we have resistance, it should now turn into support. And that's exactly what this does. And using the jump across the creek story with the Boy Scout was a clever, nice, intelligible way, comprehensive way for people to learn about this highly valuable trade setup. And then we expect to see this market rally up, and look at what it does. We see the good volume come in, the big spreads come back in, or the big ranges, and we see the waves increasing. Everything is about structure. These little bars here mean nothing unless they're in the right spot, structure-wise. Okay? And so you think about these as almost triggers or confirmation of what you're seeing. And if we talk about a Wyckoff story, we see stopping volume where demand is attempting to overcome the supply. And we see testing where supply is drying up. Supply is drying up. A terminal shakeout where they call out, where they kind of challenge the bears to come out and sell. But it fails. And so we rally back up above the low. And then it gets tested again. No supply in here. Strength comes in. We have demand over supply. And now we go back and test, and the confirmation comes in this back up to the edge of the creek where we know there is no further supply existing in this market. And this is a very good spot, very safe and very, as I say, choice, high odds trade setup to make. Sometimes, sometimes it's not as clean and as classic as this, and then the Boy Scout backs up to the edge of the creek and then falls into it, and then the market continues to go down. But we see, instead of a sign of strength here, we see an upthrust, which we'll talk about later on. But we would not expect to see high volume coming in. There probably wouldn't be clear testing and shaking out going on down here, and not the good wide spreads coming up. Okay? All right. Any questions on that pattern? That's how Wyckoff uses tests. Does it make a difference if we see a test after a sign of strength or while going down into support only? Of course it makes a difference. If it's only going down into support, it may or may not hold. You don't know. Here, for example, on this chart, here's a line of support. And the market comes down and it kind of tests it in here. We have the low volume, but then it fails, right? Why does it fail? Because there's supply right over here. So, that kind of a question is an okay question, but if you have, I don't know how to say this any more clearly, you can't just think about support and resistance. You have to think about structure and context of the market. You really want to start piecing stuff together. This is support here. Here's support here. Here's support here. And this is, I don't know what the volume is on this, but it looks like it might be kind of trying to test this. It's an inside bar. You go long on this, or you're going to get killed because, you've just had an upthrust here. You have to piece this stuff together and be able to tell yourself a story. And Walter says, well, there was support at the first test also. You mean here? There was support? Right. Would you buy that? I sure wouldn't. That's not a buy opportunity. It's testing, and it's showing that there's no supply down there, or that the supply is drying up more clearly. But that's what I wouldn't buy that. No way would I buy that. There's not enough there. Coming down, the wave structure is I don't see any change there. Here we have some change. Here we can lean against the support that exists. This is a much better spot. This is a much better spot to take a long trade. where the market comes down, rejects lower prices, and pops back up and then tests in here. This is much better. This is even better than that. This is unless you're, this is a daily chart. So if you were trading this, if you were trading intraday and you were using the daily, then you might want to be looking for long opportunities on the 5-minute or the 15-minute chart against something like this. But that's about it. Just on a day basis, close it out at the end of the day. All right, here's another daily chart, just again highlighting some testing going on. We're coming down here, we're trying to go lower. You can see that there's a little bit of testing. It's not going lower. The supply is drying up. You can draw a reverse use of trend line in here. You can see the shortening of the thrust. Is it a spot to take a trade? I wouldn't, because there's nothing there. It's still going down. Here, on the other hand, we are now making higher highs in here, higher lows, higher highs. We rally up. There's a little bit of a jump across the creek. Notice how when we are driving up through... Hi, Esther. Okay, go ahead. You have to go out, though. You can't just stay here. Go ahead. When we're driving up through resistance, you're going to see this a lot. You're going to see the market push up above resistance. Here's a little testing going on right here and here on these couple of bars. Right in here. Not real big volume coming out. Better, though, we come back into this area. Look at the testing that goes on here. And there's another test bar here. And then, remember I said sometimes it'll test just before it goes through a resistance? Here we see resistance, and notice again, driving through. This is another, you can think of this as the, this is sort of a kind of a modified creek or what have you. There's supply here for sure, and there's supply up here. That's why we have resistance. And it's driving through, so this is the sign of strength, and then it comes back and it tests this. So you have a jump across the creek here. It's not quite as defined. Remember I told you before, sometimes we'll get a higher, we won't get, if this is the trading range in here that occurs, we don't get that, classic move all the way down in terminal shakeout. Here, it came down to this level and then moved back on up. And you can even see as it's coming down that there's just not a lot of supply down in here. And then it drives up, and then we get, it's the same kind of look. You can piece it together. And again, if we're looking at the wave structure, the waves start to change shape in here, especially here, where the up wave is larger than the down wave. We would call it a markup. Yep, we would call this beginnings of the markup stage. That's right, Lars. But, these things should look similar to you. The principles are the same. When we're rallying up and there's strength on the rally, the wave should increase. We should see volume come in on the rally, and we should see the spreads widen on the rally. Look for the market then to pull back. Look for the market to then pull back into what had been resistance will now become support, and then look for that testing action to occur. And these are choice points in here. Anywhere in here is a good spot. But you have to see the strength coming into this market. Okay? So just to be clear, we're in some kind of a down move here on this daily chart of American Eagle. And we see the shortening of the thrust, right? We see a lack of supply down here. We see higher lows. We see higher high. And then we see a jump here and a push up. And then we have that back up to the edge of the creek, that pullback to support. There's a story. Okay? It's a story of strength that started all the way back here in July And it's culminating now in terms of an opportunity to take a trade position in October. You can be aggressive and take a trade in here, but that's pretty aggressive. You know, you could do it. You've got a higher high and potentially higher low here. It could be done, but the choice trade is right in here. You know, patience is a big virtue in this game. It's a huge virtue. If you're going in and trying to make a trade, you're trying to force trades out of the charts. You know, again, it's like it's the same thing. If you're taking a trade setup, talked about this the first night. We take a trade setup and you're not paying attention to structure, then at best you're going to be a break-even trader. If you're going in trying to force trades and buy against support, you know, you're not going to. At the very best, you're going to be a break-even trader, and I guarantee you're not going to even be a break-even trader. You'll be something less than that. So you can see here that we've come down into some kind of a downtrend. We got a bit oversold down here in the trend channel. We start to rally up. We see some good strength coming in here. Is it a place I would buy? No. But we see some strength coming in. It gets tested. That allows the market to rally up. Remember I said that we often see tests where the market should pull back, should turn down. Here's one telling us kind of in advance that the market is apt to rally through here. And it does. And it rallies on nice spread coming up. And it tests again. After that rally, finds no supply, dips underneath that test bar, on the next bar, and drives on up again. Okay, comes up in here. We see a little bit of supply. We get this high volume, so there's some profit taking coming in. But look at what happens as we pull back. Notice how the volume recedes, the spreads narrow compared to this rally coming up. And also, look at where it's coming to. It's just jumped across this creek. Here's a jump, right? Jump across the creek here. This is your sign of strength. In a downtrend, broken the downtrend channel, rose up above previous resistance here where there was supply. And now we come back to test it. We've backed up to the edge of the creek and we're now testing it. What was resistance should now be support, and we get that confirmed by these little test bars. And by the way, this whole wave down pulls back with narrow spreads and reduced volume. Okay? Rallies up, comes back down and tests some more because this was a pretty good move here. Finds lack of supply every time it comes down to test, and then it drives back. And notice again, as it pushes up above the resistance, we see the high volume, good spreads coming in. Okay? This is another jump across the creek. Everybody clear on that? I'm showing you one of the better patterns in the Wyckoff playbook. Laura says, when you compare volume and tests like the ones in the picture, do you compare it to the two previous bars? Lars, I don't really do that. I'm just looking for narrow spreads. I'm comparing it to, here. Let me erase this so you can see this. I mean, that's a VSA thing. So clearly, when the volume shrinks like this, it is showing that there's just no supply. And you can see it's coming back onto the top of that resistance, right? Here, it pulls back. The volume's fairly high here, but that's because there's lots of activity. It's high, but it's not high. It's pulled back over the previous couple of hours. So do I use it as a rule of thumb? Yeah, I use it as a rule of thumb. Do I say that if it's not less than the previous two bars, then I won't consider it a test? No, I don't think that at all. For example, let's see here. We got 1, 2, 3, 4, 5, 6, 7, 8, 9. And we got 1, 2, 3, 4, 5, 6, 7, 8, 9. Oh, doesn't work. I thought this might have been the way I had it labeled here, but it's not. In any event, I don't really think too much about that. Again, that is, Lars, that is focusing in on a price bar and ignoring all the context. If, you don't even need to know what a test is. If you can see that here we have good movement up, good ease of movement up. There's another way to think about jumping across the creek, right? Good ease of movement on good sustained volume, popping up above a resistance level, and then coming back down on narrow spreads, light volume. Just buy in here somewhere. That's all you really need to do. You don't need to have, get over trying to find the bottom tick or the high tick and all of that. It's, have a softer focus and really be able to see what's going on in the chart. I'm showing you the little bars and stuff, but I'm not even really emphasizing that. In fact, I'm telling you about bigger patterns to look at, like jumps across the creek, and the backup to that on the test, to get your mind into thinking about structure rather than price bars. I wish I knew a better way to do this, because I wish I could find a better way to do this. Because this is, I think, this and trading without really being able to read the market and scaring yourself silly and creating what we call in psychology a conditioned response of fear to the market are the two biggest things. You have to be in Lars says, I see, I must be seen in context, if I understood you right. Yes, exactly. Always in context. Where would I buy in this case, asked Walter. It's always going to be on something like this. That's where I would buy. None of this interests me. None of that. This is very interesting. This I'll buy every day of the week because I've got good strength. This is a high odds trade. This is a very high odds trade. As I said before, if you are looking to make trades on little tests like this and ignore the context because you see a big bar and then a test, well, you probably will do okay most of the time, but if you're ignoring context, you're going to get your head handed to you at some point, and all the little gains that you made are going to be wiped out in one or two trades. And as I said before, at best, at the very best, you'll be a break-even trader. All right. Ronald, stop losses. Ron asks, where would your stop loss be? There's different ways to place a stop. We'll talk about those a little bit later. But somewhere under here, you've got a line here. You got this line here. So, what is this? I don't even know what this market is. This looks like it's some sort of a futures market. I'm not sure exactly what it is. But in any event, you're going to put your stop a little bit below here. That's where I'd put it. Okay. Let's talk about hidden tests. It's kind of a variation of the bottom reversal, where the market pulls back, but that pullback is, narrow spreads and we don't see a lot of volume coming in. And that bar is going to dip below the low of the previous bar, and then it's going to rally up and close on its high. And the spread is going to be, most of the time, a little bit wider than what we've seen. And we sometimes call this a key reversal bar. A lot of the technicians have taken this idea and they've renamed it. Well, they've done a lot of that on Wyckoff stuff, and they call it key reversal. Okay, this is my favorite entry technique in an uptrending market. Absolutely favorite. And so you can see that, you know, we're rallying up and we get this very light pullback here, and there's a test. And it's not a really good example of a hidden test, but it is a good example. This is not a bad example. It's pretty good here. This is a regular test here. This is more of a hidden test where it dips underneath the previous support, very low volume, and rallies back up and closes near its high. Okay? I think there's some better examples here. Yeah, perfect. Here, again, jump across the creek, right? When we come back to test it. Now, notice that the volume doesn't really recede here. It's a little bit higher. But look at this beautiful hidden test. We drop underneath. And why do we call it a hidden test? Well, because if we saw this real time live, as the market's coming down and spending time underneath this prior bar, there's no volume. It's probably down here somewhere, right? All this volume is coming in. If we were watching this live, it's coming in on the rally up. And it closes firm. That's a nice hidden test. You can buy that very nicely there. Okay? And then we expect to see this thing move up, which it does. Okay? This is a 5-minute chart of the S&Ps. Here's another good example of a hidden test. We're in some kind of an uptrend here. We're making a high and a low and a higher high, right? And we come up and we pull back, and notice that the volume comes down here. Kind of not clear entry, not too clear of an entry, but look at that, beautiful. We dip underneath the previous couple of bars, in this case, and then we rally back up. And the volume comes in, and the volume is going to come in on the rally virtually all the time. And it tests it one more time. This is kind of a nice little inside bar on light volume, showing that there's no more supply. It dips down underneath and then comes back up and closes basically level with the previous bar. And then we start the rally up. And we're going. Right here, by the way. Whoops. I wanted to erase that. Right here, the market's on the springboard. Right in here. It's really on the springboard here, too, but either place. It's come dead center, right in the middle of this little tiny trading range. And it's ready to go. So those are hidden tests. Any questions about hidden tests? We'll see more of those as we go along. They're a very nice, as I say, I like to use them as an entry trigger. You don't always get them on a pullback, but we'll often see that key reversal come in at the end of a pullback or right near the end of a pullback. But again, the structure of this market is showing us that we've got higher highs, higher low, higher high. So we're expecting another higher low, and here it is. It's right in there. Okay. Pushing up through supply. Here we're going to see, and we've kind of seen this now on jumping across the creek. It's the same idea. Kind of alluded to it already, but just to make it more formal, widespread up bars, wide ranges up, and pushing up through either an old top to the left or a resistance area to the left. Okay, sometimes you'll see it gap through this area, and I've already talked to you about the true range notion. where we would just extend an imaginary line between the low of the price bar that gaps open and the close of the last bar of yesterday. And that will invariably be a wide range bar. What this is demand coming in with strong effort. And when we think about effort versus result, we're thinking about strong effort and good result of higher prices. And we're going to see, most of the time, we see heavy volume, and the VSA people say that this is the only time we like to really see high volume on up bars. It's not really the only time, but in the VSA world, they make a big distinction about this, so I put this in for folks. But we'll talk about that as we go along. And as we talked about in terms of jumping across the creek and the pullback to the edge of the creek, we want to see some testing come in after that. So here's a good example of it. Here we have a supply area. You know, you can put that. Let me do this properly. Yes, Asta, I know. Here's the creek of supply, if you will. Here is that jump or that pushing through supply. Does this look familiar now? Here we don't really have a stopping volume or selling climax. I should say selling climax here. We don't really have that, but we have a test. We have another test over here, kind of high volume as it comes down, right? And then look at this. As we come down, look at the volume here. It's a shakeout. It's a terminal shakeout, right? We come back up. We didn't quite get above the low here, but no, the low's over here. But we don't get any more supply coming in. And look, notice how as the volume is increasing, if this was all selling, this thing would be going down. This market would be going down on this increase in volume. But it's not, okay? It's just the opposite that's happening. The market's being held up. There's probably there is some supply in there, but the market's holding that. People are buying into that. And then look at this pushing up through the supply, this jumping across the creek. This was so strong, in fact, that we didn't really get a good pullback here. But notice we do have right here a nice hidden test on good low volume, where we dip down underneath the prior bar there or two, dip below the low, and rally back up and close firm. That's a nice hidden test, okay, on light volume. So this is another way of looking at jumping across the creek. But we saw earlier that whole scenario where we had a long trading range, stopping volume, testing, more testing, a terminal shakeout, and here we have the same thing, just in a little different look. It's not exactly the same, but it's pretty close. And we see the same principles coming into play. And I think that other chart was a daily chart. This is soybeans on a weekly chart. Okay? But we see those same principles coming into play. All right? Why is it not just a regular test? Why is what not just a regular test? This here, why is this not just a regular test? Because it's that key reversal type of look. That's all. Remember, a regular test is more a down bar, right? Kind of narrow spread. In here, there's a regular test. Here's kind of a regular test on the higher volume, right? So this doesn't really look like that inside bar or that narrow range bar that's down. This is actually up. But it's a test because it came down, it dipped underneath. If we saw this live, there would be no, well, you could see that there's no volume on it. but there would be really no volume on this down here. And then as it rallied, it drew whatever volume it did draw. So that's why. Here's another one. I mean, you can see it here. It's same kind of stuff. Here we see some stopping volume. Market dips down a little bit more. I would call this more stopping volume. This is probably more of a testing action, but you could call it stopping volume as well. Regardless, we go into a sideways line here. Not clear right off how it's going to break out, one way, which way it's going to break, but this does jump across the creek again here. Doesn't give you any real entry. Sometimes that happens. It's, this is too choppy in here for anything. There was no entry, but it does highlight the same principles. This wide spread, big volume after a trading range. You can think about it in terms of wave structure. We're coming down. The wave structure now changes, right? It's big down here, big up here. Clear. Okay, good. All right. You don't have to have this jumping across the creek idea. We kind of alluded to it earlier. We don't have to have it at the bottom of a down cycle. Here we have some kind of a bottom down here. We rally up. We hold some kind of absorption, most likely. If we were to look beyond this chart, we would probably see some sort of an old high here. We drive up, and then we we go into this long trading range. All right, same kind of thing though. We see it comes back, and we've got some volume, but not huge volume. We get testing going on here in this little volume in this area. It rallies up, it fails, we come back down. Look, we get more volume coming in, but we don't go down. Instead we pop back up. Testing goes on in here with the narrow spreads. It's kind of at the end of the day, so the volume is going to be a little bit bigger. And then look at what happens. It jumps across the creek. It doesn't really back up nicely, but we do get those testing we do get that testing action in there. Okay? Where the volume is less. And I'm not sure why I did this. We kind of are going up, and we're seeing, you could kind of say, oh, this looks like it's shortening of the thrust, right? Because it's kind of rounding over. But look at this. It's not, each time we pull back, we're getting less volume, and we're not getting any kind of a pullback. What we would want to see after a shortening of the thrust is we'd want to see the market pull back and go lower, put in a lower low, and we'd want to see volume pick up on that lower low and then rally back up on a weak rally with volume coming down, and then we would short in here. Okay? That's what we want to see after some kind of weakness here. All right? Structure-wise. But instead, what are we seeing? We're seeing some shortening of the thrust, but then the market's holding gains and testing in here. Each time it comes down, it's not drawing out supply. So therefore, it's probably going to go up, and that's exactly what it does. And here you can see there was a mini little jump across the creek up here. Right? Pushing up through that supply. Jumping across the creek here as well. And there's no change in behavior here. That's right. We're getting some shortening of the thrust, and the up waves, we get good solid up wave, a down wave, up wave, a down wave. Up wave starts to shorten. We get a little bit of a bigger down wave, but I wouldn't call that a big down wave. And then we just kind of go sideways, and that's absorption. This looks more like absorption here, and then it starts to rally up. All right, one more time, highlighting these supply areas. And let's just talk about why we get this kind of action here. Why do we get this kind of action? Well, there are a lot of traders who trade, and they are, you know, making all kinds of crazy little mistakes all the time. And so you will see them, for example, this is, you know, just a little bit of a high up here. They're watching this bar coming up, and they're saying, oh, this thing is about to run to the moon, and they buy up in here. So they're buying in here. And believe it or not, they will hold on all the way through here. Okay, all the way through. And it starts to move up, and other people are going to be attracted. People get attracted to these widespread bars, and they buy on these things. Okay? And they buy in here. And they hold on all the way through these pullbacks. And, you know, they suffer through them. And then, as price comes back up to their area, they're thinking they're lucky stars that they can get out, break even. Okay? So they're selling into this rally where they shouldn't be. This is where they should be buying instead of places in like this, but regardless. And there's also support and resistance traders, and they're seeing this level as resistance and this level as resistance, and they're shorting against it. And there's also people who bought down in here and over in here, and they're looking at this level and saying, this is where I want to take profits. It's a good spot to take profits. And so they'll sell out here. So every time we come across a level like this, there is a lot of supply, both in terms of trapped buyers needing to get out or looking to get out, sellers that sell against resistance, that short against resistance, and then people who are holding long positions looking to take at least a piece, if not all, of their trade off at prior resistance. They're using that as a target area. I often do that. So that's why we have the supply here. Okay, that's why we have the supply here. So the market needs to drive through that. Otherwise, it's going to get caught here and it's going to fall back into the creek, right? It's going to fall into the river. And we're going to go down and down and down, because then sellers will see that and they're going to jump on that. Okay? So the market needs to drive through this. Call it smart money, call it the composite operator. I just think about it in terms of the market. But the market needs to drive up through here. And then it's always going to do this little testing action. We don't get a good pullback here, but we do see the testing going on. And this is a hidden test here, and this is a normal test in here. Okay, and you can see that this test is on slightly higher volume. So Lars, it's volume that's not less than the previous two, but it's lighter volume relative to what we see coming up. And it's not closing on the lows. If we saw a wider spread down here, then I would be, coming back into this level, then I would say, potential that we could come down lower here. That supply has suddenly come in. But it's not doing that. And so, you have to be able to see the background and what's happening. This big move up here on all this volume, even though this is higher volume, it's not enough to negate all of this. So that's what I want to say about that. Any questions about that? Everybody following this okay? Is this making sense to people? Let me get a little feedback here so I know how people are how people are responding to this. Is this helpful? Let me put it that way. Okay, good. I'm getting a bunch of yeses here. All right, good. Okay, let's go on then and talk about springs. Here, the price dips down below support and rallies up to close back up above support and typically on or near its high. But the key thing is it's got to be back up above support. Okay? And to start off with, just look for, well, and I'll show you what I mean by this, but look for volume to be less on the spring area than where support first came in. Okay? As you get better at these, you get experience with them, this becomes less important. This volume, I've seen sometimes where the volume is substantially higher than the volume where support was first created. But to begin with, the safer trades are on the spring. You want to see less volume, meaning that as we come down, in other words, we've got a support level, market does a little rally, comes back down to this level here, comes underneath, and then comes back up and closes above that support. This is the spring. Okay? And we'll typically see pretty good volume here. Here we want to see less volume, at least to begin with, when you're first learning how to trade this. Okay? Now, here's the dilemma about springs. Springs are often, but not always, tested. So we'll see the market rally up a little bit, test first, and then take off, but not always. And some of the best springs just go straight up, almost. When we're in an uptrend, they're very reliable. And when a trend change is clearly underway, they're also very reliable. If it's a downtrend, don't touch them. Okay? Context, structure. All right, here's a chart of ISRG. Sometimes people say, wow, look at this. I could have bought it down here at 143 or so, right? When the market was down here. Now it's all the way up to 220. It's almost 80 points higher. I can't buy that there. Well, sure you can. This is perfect. Here's a spring right here. We have a support level. The market rallies up. It comes back down, dips underneath, closes back up above it. That's a beautiful trade right there. We also see the market rallies up, pushes up here. There's strength in this market, a higher high. We get a little weakness coming in. Market comes back down, dips underneath this level of support, and holds that very nicely. That's another spring right here. Okay, and then rallies up from there. Now, on this chart, this is interesting. Here is the high here. Here's that resistance. And remember I said sometimes it will gap open, and if we take and we do this kind of a thing, this average, this true range from the close to, this bar here, that's what this was, and it's on big volume, and that's nice. This is pushing up through the supply. This is jumping across the creek here. And now we come back and we kind of test that a little bit, and we get a spring on the test. How much better is it? It doesn't get any better than that. And yet, most traders won't buy it because it's too high. The price is too high. Well, if you bought it in here, and you would have bought it at, 2018, 218, and, it's now up to 260 here. That's a 40-point rise in that stock in less than a month. Pretty nice. Would I trade it on the close? Yeah, I'd buy it on the close of this bar or the open of the next bar. If we're trading here on a daily, often I see these on a 5-minute chart and I just go in. So yeah, you would either buy on close or buy the following opening, the next morning's open. Here's another example. sort of a different look. We're coming down. We have climactic action here. We have some stopping volume. Market comes underneath. It does it not just once, but a couple of times. Sometimes you'll see this. Comes underneath a couple of times. This is Apple on a daily basis. Springs it, and then comes back and tests that spring before rallying up. But it's the same principle here. Okay? And here you can see clearly the down waves are bigger than the up waves, right? Then the down waves get smaller, and suddenly the up waves are larger. We get that test in here. That's not a bad spot. That's a good spot to put on a trade. And now the up waves are bigger. Here's a hidden test right in here. Dips underneath. Volume recedes. And there's another spot. Right? Same kind of stuff over and over and over again. We see all the time. Here's a chart. This is SPY, the ETF for the S&Ps on a 5-minute basis. Here's kind of twin sisters. We're in some kind of an up move. We get probably some kind of news or something comes in here, and we've got this churning going on. Looks like supply wants to come in. But look what happens. We spring under here, closes and comes up. We come back down. This is actually testing, but we can draw another line here and it springs that and then starts to rally up. So another way to think about springs is this, is that it is showing you a failure to follow through. Okay? So here we have supply come into the market and supply come into the market, and you know, you're looking at this and you're saying, okay, this doesn't look good. I would be standing aside. I wouldn't be trading in here. And maybe I would even have a short trade on. I don't know. Probably not. But let's say that I did have a short trade on. Let's say that I tried to, somehow I got short in here, or I don't know. Somehow I just shorted in here somewhere. Okay? And now, here's the last low. Now I'm expecting the market to come down and make a lower low. You know, maybe I'll think about adding to my short as it comes back up into this area here, add to the short and see if we can get the market to come down at least to, and maybe go through this low over here from the prior day afternoon. Okay? That's the way I would be thinking. Now, what happens though? We come down, here's our low, we come down below the low, and suddenly the market doesn't go below that. It springs it. Well, we might say, okay, maybe it'll just, you know, die there. It looks like it starts to come down again, but look at, we see more buying coming in here on the first black arrow, and then it comes underneath and springs it again on the second black arrow. So if you were short, you'd have to get out of there. You'd have to exit that trade. And better to go long on something like that, because it is not following through to the downside. Okay, that's the idea of a spring. Failure to go through the downside. Here's another example. This is a weekly chart of a stock where we're coming down and we have big, wide spreads down. Clearly some buying coming in here, and that establishes a support level. And then look at this down move here. Compare this with this. Is there any comparison there? No, none whatsoever. This is choppy. There's no ease of movement here. Here we have ease of movement, and here we just have slop. Right? So it does break down below for a week and a little bit longer than a week. But look at what happens. It turns right around, fails to go any lower. It turns around, closes firm. Well, that's worth a bet right there. That's worth making a trade. And you can see the response that it gets. We go from whatever that is, 25 to 35, 30 and change, 31 in 6 points in a week. And then that's telling you that it wants to go higher, and look at it, it goes all the way, the response to that spring. It's very nice. Okay. Whoops. I think we saw this chart earlier, but this is another example of a spring. We're coming down. We have some climactic action here. We get oversold in the trend channel, and we see that plummeting, right? We saw that before as a selling climax. And here at B, it dips underneath, fails to go lower, and springs. And then comes back in and tests it on low volume. A nice hidden test in here, a nice regular test. Market's on the springboard right here, because we've come back into the same area where high volume was seen both on the climax and on the spring here at B. And when we come back in, look at the volume. It's not even half what we were. It's below average, and it's not even half of what we were at A and B. So there we are on the springboard, and there it goes. It takes off. And then we have another test here at F. Okay. And we didn't really, this is another jump across the creek. See? High volume, wide spread coming up. This one doesn't quite close that firmly because there was probably a lot of movement down here, and we're just going sideways for a couple of hours. But still, it doesn't matter. There was a lot of people were still people were selling against this, but the market says it wanted to go higher, and it came back up and tested in here, and then rallied up. That was a nice rally on this day. It was one of those days where it turned around in the afternoon. This is an S&P 5-minute chart. Here's a nice clean example. Here we come down, we gap open, we see a little bit of buying, we come down and we spring it. And here's a good example where there was no testing whatsoever. So sometimes the spring will go much faster without a test. But again, it is rejecting lower prices. There's a failure to go lower after we dip down. And the key thing is that it closes up above the support level. Here was support. It dips underneath. And that was showing that support is firm and holding. And then we get this kind of a move. All right, I think that's it for springs. Yeah, that's springs. Any comments on springs or questions about them? Could one call them three springs? Oh, because there's 3 down bars or 3 bars dipping underneath? No, it's just, it doesn't occur until here. It doesn't occur until here. So, well, that's not really true, is it? I'm sorry. It dips underneath and closes, dips underneath. Yeah. So I wouldn't call them 3 springs, but it's, how would I say this? Sometimes this will happen. It's not as clean. What I like to see is more of a firm. In other words, when we're still making lower close, lower close, lower close, I'm not excited about that. I want to see that firm close. So this is experience coming in. I wouldn't be buying these, even though it is closing up above after a dip down. I wouldn't buy that, but that's experience talking now. I'll give you another example. If this bar here, this second bar, did this and close like that, then I would buy it. Okay? In other words, if it had this longer sort of tail and then rallied back up, and there was a good effort to close back up, then I would buy it. Because then it's saying that sellers push it down, but buyers stepped in and rallied it all the way back up and closed it firm. Okay, so then I would buy it. But I wouldn't buy it when it's just dipping slightly underneath like that. Okay, I like to see it firm. Yeah, you've seen it many times too. Yeah, and that was a good question. Make the market tell you what it wants to do. Let's just talk a little bit more about this. These last two bars, ignore this for a second. Just ignore this. These are not strong. These are not telling us that there's anything strong going on. What it's telling us is that it's still kind of weak coming down here. Yes, we got good volume, a pickup in volume here, and the market is not falling. That's an indication of strength. There is a little shortening of the thrust in the price bars, the lows here. That's another indication of strength. You'd be aware of those things. But it's not clear and clean. And it doesn't become clear and clean until this next bar. Okay? And again, it's experience telling you this stuff when we see this. If you start looking at price bars, and you'll see it. Here's one, 90% of the time when you see something like this, where it dips underneath and then rallies up and closes firm, then we're going to see some follow through, right? Here, same thing. Dips underneath, closes up firm. We're going to see some follow through. Here's an example where it dips underneath, rallies up, and we get a pullback, but we still get that follow through. Overall, the buying is still stronger, right? Here we don't get that until this point here. Here we get it here, where we rally up and it's strong. So, pay attention to that. It's important. It's important. The individual bars like that all tell a story. Okay, let's talk about stopping volume. Sometimes we don't get climactic action. Sometimes it is just stopping volume that occurs. But in any event, it's demand or buying that's overcoming the selling or the supply. And it's going to come in after some sort of a down move. But we're not in a big, long down trend. It's a move rather than a trend. Okay, that's the difference. That's the main difference between stopping volume and climactic action. And we're going to see that volume expand, and the bars are going to close mid-range or closer to their high. And it often will come in on a couple of bars, and you're going to see, if it's occurring on 2 bars or sometimes even 3 bars, you're going to see high volume on all of them. You're going to see that first bar closing down near its low, and then the second one is going to pull back up and close mid-range or higher. Okay? So here, for example, on A, there's no downtrend here, really, to speak of. Right? I mean, there's a slight one, I guess. You could say there's a downtrend here, but it's not what I would call a long, drawn-out trend. But we drop down, and we will see the bar expand. We almost always see that. The volume is the largest on the chart. Look at the close is in here. So sellers brought it all the way down, and buyers stepped right back in and closed it up. And then the market now goes sideways, and we see more buying coming in here, and then it starts to rally back up again. Still looks pretty weak, but this was enough volume to stop the down move. That's the idea behind stopping volume. It doesn't mean that we're going to see a new trend develop immediately to the upside. What stopping volume means is that the down move is going to cease. It doesn't, it could go sideways or it could go up, but it's not going to continue to go down. Okay, Asta, yeah. Okay, good boy. Here we're in a trading range, and the market falls out of that but the volume is very high. Price closes on its low. We get that gap down. We could extend that. I won't do that here, but you can extend that and you can see it. And that stops the down move for at least the time being. And you could draw in a trend channel here and you can see that it's getting weak here and we're liable to come back down and retest this at least. I don't remember what happens on this chart. But the key thing is that this high volume and this bar, the buyer stepped in and stopped this down move. That's stopping volume. Okay. Here's another example where we're in some sort of a down move. High volume comes in. Now this time it's over a couple, 3 bars. And we see it looks like on the first bar here, bar A, that it looks like it's just going to go down. But on the very next bar, still high volume in here. And sellers couldn't take it down any lower. In fact, couldn't even go below A before buyers stepped in. And then on the next bar, buyers pushed it up. And so that stopped the down move, at least for the time being. Okay? Later on, it proceeds to go down. But you get the idea that when we see volume swell like this, the market's going to stop. Okay? Here was kind of an interesting day where this is a 5-minute chart of the S&Ps. We're up near a resistance level here, this 2-day high, and the market opened up, dipped down a little bit here at 1, tries to rally up. We see high volume come in, and look at the spread narrow, right? We talked about this on last time on the downside where the spread gets narrower. Well, here sellers were stepping in, right? And they drove it down. Here's a bit of a down move. This is only a 5-minute chart, so things happen very quickly. But look at B. Look at all the volume. The biggest volume, of the morning. And usually you see the highest volume in the first half hour. And this is coming in at the end of the first hour. High volume. And they're closing it in the middle. Sellers cannot bring it back down to the low. We still see high volume. And then we start to rally up. Okay, and it holds. We get a spring over here, and then it took most of the day to get going here. But this was stopping volume. This is another version of it right in here. Some stopping volume, stopping the market from going down lower. And it toyed around with that resistance level half the day, and toyed around with the stopping volume. You can also see this. Look at this in terms of, we came down here at F and held, and we had this kind of volume, testing this stopping volume, right? And then we came back down here at I and J, same area, and you can see that the volume here was substantially less. So that's another way to think about it too. This on a bigger picture, maybe a bigger time frame, this is some kind of a test going on down here. Okay? Is the stopping volume something that I would trade in this picture? No. No. I think this was the place where you would make a trade here on J. Sometimes you have to be very patient. I look at this and I think this is fairly, this is 84, maybe 83, right? 1183, and the high here is 88 and a quarter, maybe 88 and a half we'll give it. So that's 5.5 points. I'm looking at this thinking this is a narrow range day. I probably walked away from this day because there was just nothing to trade. It's too small a range. There's no volatility in this. Probably went to something different, maybe bonds or the euro currency or something. Okay, all right, Asta. Here we have another example of stopping volume. Little different, but here we're coming down. There's a down move, and we see the volume swell here, and high volume, narrow spread, and the market closes more firm and then starts to test it in here. And look at the volume on that test. Notice also that we have a bit of a spring going on high volume, if you will. And then the market starts to rally up from there. But this was really stopping volume. High volume coming in just below support. Then it gets tested and then rallies back on up. But again, the idea is that stopping volume stops the market. Doesn't necessarily mean we're going to get a rip-roaring new trend to the upside, but it does indicate that the downward movement will stop. It could just go sideways, but it indicates that the down move is over. All right, any questions on stopping volume? Pause for a minute. All right, no, I don't see any questions. So here's my suggested assignment for you. We're completing the indications of strength. Start to look through your markets that you trade on the time frames that you trade on, and start identifying these signs of strength that we went through. The bottom reversal, the climax, the test, the jumping across the creek, pushing up through supply, springs and stopping volume. Okay? But do it in a little more sophisticated way than we have been doing it here. I've been looking just at these patterns. Now what I'm going to encourage you to do is to integrate it with trend lines and waves. Okay? This is the key idea here. You start to use the structure and the context of trend line and waves, and then put these into that context. And I think it'll start to open your eyes as to where you want to be looking for trades. Okay? Question came in, would I say that stopping volume is something that you would label after you see confirmation on the next coming bars? Probably not, Lars. I would see the swelling of the volume on stopping volume, and I would be thinking that it's probably happening there. It's not necessarily a spot I would go take a trade on. Like, I would not buy this down here. That would be crazy to buy this. I don't see anything in here that I would buy. But if I were, let's say that we're in this downtrend here, right? And we see some sort of shortening of the thrust here. There's a little bit of an up thrust here. Let's say that I went short here, okay? And I'm happy. We've broken down below the demand line. Notice how we break that demand line on good spread, good volume. Just the same as we were talking about pushing through supply. Now we're pushing through support. We're going to see that. I don't know if we'll get to it tonight, but we'll see it. It's the same idea, okay? When we break a trend line, we want to see it break on good spread and good volume. And so we see that. And now we start to come down, and I notice this big volume coming in here, and I would draw a trend line in, trend channel here, and I would note that I'm oversold. I would take the trade off here if I got short up here. And I'd say to myself, well, I had a nice 8 or 10 point trade, whatever I got out of it, 9-point trade. Because you'd be able to recognize that this is potential stopping volume, and you want to exit that. It's possible that the market might just come up here, test this high in here maybe, and then fail and continue to go lower. But you don't know that at the time you see this. But what you do know is that somebody's coming in and buying that market, and they're buying it in force. You don't see this kind of volume elsewhere, right, in this chart, at least on this down move. So that's telling me that, swelling of the volume is stopping volume. Stopping volume means that the down move that I'm in, if I'm short, is now over. So why should I hold on to my position? And, in the S&Ps, you get to know this after a while, that here we're at 873 on this, and down here it's 862 or so. That's a 10-point move. That's pretty good in a 30-minute period in the S&Ps. That's a pretty good move. And it's unlikely you're going to see much more anyway. So that's what you would be thinking about. Okay, you've got to learn. You got to spend time with the markets and learn their subtleties. I've been trading the S&Ps for over a decade, and I know that a 10-point move in a half hour is pretty good, and it's unlikely that we're going to see more than that. And I see stopping volume coming in, and I'm oversold in a trend channel, and I don't know what else is going on bigger here. Maybe there's some 60-minute support down here or something. I don't know. Daily support. I'd piece all that together, and I'd say, that's time to go. That's what I'd be thinking about. So if you start to pair these signs of strength with trend lines and wave integration, you're going to start to see things that you've never seen before, hopefully. And you'll be well on your way to, being able to read the market and read the areas of the market where you want to be thinking about taking trades. Okay? And, note down your observations. Don't just do it mindlessly. Be mindful about it. Note your observations here. Does it require testing? Does it not require testing? If there's no test on a spring, what else is going on in the background that might give you a clue that would tell you that the spring wouldn't have a test, but it would just start driving on up through? There's only so much I can tell you. I can't tell you a decade's worth of experience in an 8-week course, but I can try to tell you areas for you to begin to learn it for yourself. And in the end, that's what you have to do anyhow. Whatever it is that I tell you is, one thing, but you've got to really see this yourself as well. All right, any questions on that suggested assignment? And I'm assuming that there's none. So I'm going to jump in. We're going to start talking a little bit about weakness now. And we're getting close to, I got about a half hour here that I'll go. So we'll probably get about halfway through this. Well, maybe not quite halfway, but we'll get through some of it. And then we'll just pick up where we left off this week on Wednesday next. And we'll keep pushing forward, okay? All right, so now we're going to just sort of flip these all around and look at some of the major indications or major signs of weakness. Signs of weakness, okay? We'll talk about the upthrust. We'll talk about top reversal, or what some people call two-bar upthrust. Talk about the hidden upthrust, no demand, pushing down through support, and then the buying climax. So in most cases, they're the reverse. This is the reverse of a spring, right? This is the bottom reversal, the two-bar bottom reversal. And this is the reverse of a hidden test. This is the reverse of a test, the no demand. This is fall through the ice. Fall through ice. That's the reverse of jumping across the creek. Okay. And then, of course, buying climax is the reverse of a selling climax. So in a lot of ways, you've already seen these, and that's kind of good because it will reinforce what you saw before. on the flip side. But these just happen and give us a sense that the market is now weak. All right. Once again, let me just remind you, these are definitely, no question about it, very important signs of weakness. But please, do not treat these as signals, because they're not signals. Background and structure is always the key. Okay? I think you guys are probably starting to get that. Okay, upthrust. We need to have an old top in the background or resistance, a clear indication of resistance in the background. We can't just have what looks like a weak bar and say, oh, that's an upthrust. That doesn't work. So price, it's the opposite of a spring. Price is going to rally above that resistance and then fall back below it. And then price has got to close below. That's the key idea here. Close below resistance. And it's best when it does so on or near its lows. Okay. And volume can be, relatively heavy or light. And this is a little more flexible than springs. If it's light volume, it suggests that there's no buying up there. If it's heavy volume, it's suggesting that supply is coming in. And I actually like to see this heavy volume. It's kind of like stopping volume in reverse. It's stopping the up move, if you will. Okay. So let's take a look at a few examples. Here's a clear, clean example of an upthrust. We have resistance in the background. Okay. Market has been coming down. We have this pop up. It opens up. We come back down. We try to rally back up above it. Look at the rally too. This is also very helpful to do. Look at this rally. Look at this. Just no volume coming in on that rally, right? And the market peaks up above the top of resistance, fails to hold it, and closes down here below resistance and happens to close on its lows here. And so I know you're going to ask, where do you buy, where do you sell short this? Well, that's a good spot to sell short right there. And if it's too much of a stop, you reduce your position size. Or if it's too much of a stop, you let it go. You pass it. Okay? And then if you look here, we're going to talk about no demand a little bit later, but this is a no demand bar. It's trying to rally up. And there's just no ability to rally here. We see more supply come in. This is weakness all over the place. It tries to rally up one more time, and look what happens. If we drew a line here, we have another kind of upthrust in here. And it closes and it starts anywhere in here is a good short. So if you didn't short it here, you could short it here. Okay? And you still have a very nice move captured. So it really doesn't matter. Now, this is kind of testing that upthrust in here. This whole thing is kind of a test of that upthrust. You don't always get those. Sometimes it just goes straight down. And so that happens. You have to decide ahead of time how you want to trade. We'll talk more about this when we talk about trade setups. But you want to decide, how am I going to trade these? Am I going to trade them? Same thing with springs, if you're going to trade them. Am I going to take it on the spring bar, or am I going to take it on a test? Make that decision up front and stick to it. Don't go back and forth. Do one thing or the other. Or if you want to test different entry strategies, do one for a couple of months and then do the other for a couple of months and compare and see how you do with each. You can do that, certainly. In the previous picture was the 2 bar, the inside bar. The B bar was the inside bar, yeah. This is this is B here, and it's an inside bar. In fact, everything is inside this other bar over here. It's just showing that there's no ability to rally this market. Everything is inside there. Okay. Here's an up thrust. I think that was a 5-minute chart. Here's a 60-minute chart. They come in all shapes and sizes. Let's go through this chart a little bit. Tell me what you see here. Tell me what you see that makes this a choice trade setup, that makes this up thrust right here a choice trade. Let's see what you can see here. And use some of the stuff that we've been talking about. What do you see? Shortening of the thrust. Good. A change in behavior. And then the last, what's the change in behavior? And as you're talking about that, I'm going to talk about shortening of the thrust. We certainly see shortening of the thrust right in here, right? It's very good, Lars. If we were to draw that little graphic that I like, you would see the shortening of the thrust occurring right like that. Okay? A and B, whoops, sorry, and C and D. You can see that shortening of the thrust. And then the larger down move after the shortening of the thrust, that's the change in behavior. Very good, Lars, very good. So you can see that we've got, nice up waves going here, kind of going sideways. They start to increase a little bit, but the shortening of the thrust indicates that the up waves are getting shorter. And then look at the down wave, right? Look at that down wave. And also, we're getting good volume coming in as the market's going down, or trying to go down. Here, we're getting good volume coming in as the market's rallying. Here, we get volume coming in, here we get volume coming in as the market is rallying, right? Now, suddenly, look at this bar. Look at this volume. Uh-oh, not a good sign, right? We also see less volume on this rally. That's this bar here. Suddenly, the buyers are tired, okay, indicating shortening of the thrust. Potential. We don't quite see it yet, but certainly by this point we do. And because this bar closes so poorly and on big volume, it's saying supply has come into the market. Only selling can do that. Then look at the rally up for the next few hours. It's terrible. There's no volume on that rally. And then for the next couple of days, we come down, and each time we drop, we see a pickup in volume here, right? Stopping volume here, yes, but volume coming into the downside, nevertheless. And you can draw trend lines in here, and you can see that it's going to stop at that point. No question about that. But the overall structure is showing that we now have a bigger down wave for the first time and smaller up waves for the first time in this trend. And we see signs of supply coming in. Okay, everybody see this. This is really important. This is how you read a chart. Now we just wait. We just lie and wait. We don't do anything until we can lean against structure. And the market rallies up, and we'd be dropping down to a 10-minute or a 5-minute chart or a 15-minute chart. We would see this market rally up, try to hold up here, fail, start to come down, and you'd see it on pretty good volume, and you short it. Okay? Or if you're trading off of an hourly chart, then you short it here. Because the odds are so good that this is just going to go down further from here. Okay? Everybody see that? This is how you do it. All right. Here's another couple of examples of up thrusts. Here we're in an uptrend and we go into a sideways range here. We peak up above this old resistance, and this is definitely an up thrust. And we get that good volume coming in on a negative bar here. As we try to rally up, we have what we call no demand. Notice we get that, this is what we would call a hidden up thrust here. Very similar to what we saw the last time. Okay, and this is a different market. This is XLF, the ETF for the financial industry. Okay, we rally up. You can do the trend line in here. You can see that it's overbought in the trend channel. We see big volume coming in and negative bars here, right? And then we try to rally up. Looks like maybe it's going to try to do some absorption here, and this is the difficulty with up thrusts. We never. Sometimes you'll see this, and this is where it can get vexing. Is it an up thrust or is it absorption? And sometimes it will up thrust and then go sideways, and then you got to realize if it doesn't go after the up thrust or shortly after the up thrust, and it just holds up in here, right up underneath. I mean, right in here. If it's just holding, then you've got to assume that it's absorption and you want to scratch out of that trade. But here you can see that the volume picks up and we just start going down and down and down and down. And so now we've got a clear sign of weakness. We try to rally up. We get, more negativity coming in and the market comes down. So there's a couple of examples of up thrusts. The 50% line of the range is a good risk line. It probably is. Yeah, 50%, Wyckoff used to talk about that as a good line in the sand. Here is Goldman Sachs on a weekly basis. I always like to show this chart to show what the potential for an up thrust is. So tell me, what do we see here in terms of weakness? I mean, here's clearly the up thrust. And I haven't shown what the market does, but here's the up thrust, right? Why is this market weak? Why is this market weak? I'll never forget this. This was in 2007. So you know that this is the 2008 bear market. But this is 2007 and we were watching this and we were seeing this unfold. We have shortening of the thrust, right? You can see it right here. You can just see this thing arching over where we're making less. And that goes to here and then to here and then to here approximately and then on up to here. So you can see the shortening of the thrust occurring, right? Change of behavior in the previous down wave just makes a lower low. Yeah, very good. Look at this. Here's the wave structure, right? Big wave up, small wave down, big wave up, smaller wave, but still a pretty good sized wave. And then bang, look at that. Okay? Similar to what we saw before. So now what we do is we wait. We're patient. And we wait for this kind of a situation. Or we might get a lower high and then it starts coming down again. Okay, one of those two things. But here we get the up thrust. That's what we're looking for. Also notice, as we come down, look at this volume here. Clearly some stopping volume. Let's just take a look at that, since we talked about that. Right here, we get high volume, highest volume on the chart. Market dips down, buyers came in, closed at mid-range, and then it held. That was stopping volume. But is this, look at the volume coming down. And even here, we saw it all the way back here in March. High volume coming in on the reaction. We hadn't seen that before. And this was sort of the first indication that supply was coming in. This was a big. We sat there and we watched this. I remember talking with David about this and saying, good Lord, look at all the volume coming in on this pullback, on this move down. We didn't think it was going to rally back up to the top. We really didn't. We thought I think I shorted maybe 2 or 3 times in here and finally had to stop because I kept getting stopped out. But, it just was looking so weak. I was too eager at that point. So let's see what happens on this. Here's where we were. Here's that upthrust right here. And there we go. So we went from, I guess it was just under 250 all the way down to $50. So we lost, quite a bit. And, by the way, if we went back to, I think it was 5 years earlier, we would see that just around, I think it was $53, give or take, $53 and change, was the low, the low 5 years earlier in Goldman Sachs. And it came right back down to that spot, okay, that support and resistance. Again, stopping volume coming in, right? It took a while to stop this down move, but this was where it stopped. I understand it went down lower, but this is really where the buying came in force here, around the $100 mark. So that's an upthrust. When you see it occur on a weekly basis, remember that chart from Goldman Sachs because it's pretty significant. All right, let's talk about the top reversal here. It's very similar to an upthrust, except it happens over 2 bars. The first bar rallies up above resistance and closes up there. So it looks like it's going to be a breakout, and it traps people. This is a big bear trap, or bull trap, I guess, is the proper way. It traps everybody going long. And it looks like, oftentimes it's on its highs, and so it looks really seductive. And a lot of people buy on this. But then the second bar rapidly reverses. I love this setup. And then it closes below the resistance. And, you can play all kinds of games with this. It's strong. The indication is even stronger when the second bar closes below the low of the first bar. I would say that it's even stronger if the volume on the second bar is bigger than the volume on the first bar, and so on and so forth. You can think it through. But here you go, right? And look at this. I mean, you should be able to get to the point now where you can read some of this stuff, right? Look at, this is the Russell 2000 on a 30-minute basis. You have weakness that had come in here. It rallies up and then comes back down and closes here. And then it spends all this time down here and finally gets back up. And at A, it looks like, okay, it's closing and it's closing firm up there, but then look at the next bar. Bang, it comes down. Right? And then B is this no demand. And we rally back up and look again, we get this, inability to rally, and it just goes into this little kind of apex trading range and then falls down from there. But that's a top reversal. Here's a beautiful example of one. Actually, we have an upthrust that occurs here on A, but it doesn't give us much. It doesn't yield much. And then we rally up, and it looks like now, because this has, it looks like there's going to be some follow-through, and sometimes upthrust will do this. Springs don't do this that much, but sometimes upthrust will do this. Sometimes it will go up a couple of times. Usually not more than 2. I don't think I've ever seen it more than twice. But you'll see it go up, it upthrusts, and then it doesn't go anywhere. And then it pulls back up, and then it upthrusts it again. And this is a classic top reversal right here, where it looks like it's going to go up, and it does, in fact, go up a little bit higher. It traps everybody up there, or a lot of traders, and then it comes zinging back down, closes below the low of the first bar, And that's it, boy. It just, look at that thing move. That was incredible. That was incredible. So that's a top reversal. Hidden up thrust. We'll do hidden up thrust and then we'll call it a night, I think. It's a reversal bar to the downside. And we can call it hidden because it up thrust resistance on a lower time frame or very minor resistance. I'll try to explain that in better detail. It's a Tom Williams concept. And the same thing with hidden tests. It's the reverse of that. And it is the reverse of a hidden test, and I really like this in a downtrending market. It's my favorite entry in a downtrending market. So, for example, here we are coming down, coming down, coming down. We do get a little stopping volume, and it does kind of stop the market here. But as it rallies back up, this is the hidden up thrust right here. That's the hidden up thrust. It's just a key reversal bar on a rally, on a weak rally. When we see that there's no volume coming in on this rally, it's hidden in terms of up thrust, and here's the Tom Williams concept. If we were to drop down to a smaller time frame, this is a daily chart, okay, of IWM, the ETF for the Russell 2000. So if we were to drop down to, say, a 15-minute or a 30-minute chart, this would be an old high or a resistance. Presumably, the market would have dipped underneath that and then come back up the next day, rally up above it, and then come back down below. So there would be a top and then a down and then back up and then here. So we would see that maybe on a 30-minute or a 15-minute chart, especially if we included the overnight action, right? But here, we're on a daily, we're on that same time frame. So we're just assuming that that happened. And that's why it's called hidden up thrust. I think about it as a key reversal bar where the market pushes up above the high of the previous bar or two and then comes down and closes, you know, in the lower 1/3 of its range. And then that I would consider to be more of a hidden up thrust. You also have one that's right here. We don't have much of a rally. I'd like to see this have a, you know, more of a weaker rally here, but it's the same kind of concept where it rallies up above the previous bar and then closes poorly. It's the same kind of idea. Okay? Same thing here. Rallies up above the previous bar, closes poorly. Now, obviously, if we're in an uptrend, you'll see this. But it's not the thing to be taking in an uptrend. You want a good, solid downtrend. Lower low, lower high, lower low, right? Breaking out of a trading range. Look at this, breaking out of a trading. We're going to talk about this. Is a key principle of price behavior. Typically, we're going to see this occur, and when that does occur, this is going to set in motion a good downtrending move. All right. Here, we don't really have any kind of a breakdown, but we see weakness coming into the market. A little bit of high volume here and closing poorly. Sometimes people will call this an up thrust. This is not an up thrust. They'll call this an up thrust. It's not an up thrust. When we're in a rising market, and you know, sometimes people will say, "Well, look, it's an up thrust." No, it's not an up thrust. We went through the examples of the up thrust and showed that there was weakness in that market and stuff. Here we're making higher highs and lows, higher low, higher high, higher high, higher low. There's no way you'd want to be shorting this, okay? But up here we get a little bit of weakness. We start coming down, and then we get a weak rally here. Not much volume. You can compare it to the volume on all the other rallies, and you can see the difference. And we get that hidden up thrust here. We come down, volume increases to the downside as we come down. We get that weak rally. Beautiful hidden up thrust here. Okay, these are great little trigger points to take a trade. And you can, you know, you'll often see them lining up against resistance and so on and so forth. Okay? Should be pretty clear. They're lovely. I love these. Here's an example where you can see we're dropping out of resistance. We have a lovely hidden up thrust here where we get a weak rally. And in fact, you even have an actual up thrust here. And then a little bit lower, we try to rally up around this area, and we get those hidden up thrusts in here and in here. Very nice ones. Okay. All right. I think we will stop here. How does that seem to everybody? Okay? All right, good. So the suggested assignment, focus in on strength. Focus in on strength and look for those indications of strength. The 2-bar bottom reversal, the selling climax, the stopping volume, the tests, the hidden tests, and the pushing through support. Or I'm sorry, pushing through supply, jumping across the creek and the back up to the edge of the creek. Look and connect the waves and the trend lines. Connect the structure with those and see what you can see. All right? All right, any last questions before we end here? One last question. Okay. Regarding springs, does the single spring course go more specifically into the topic? Yes, it does. It goes deep into the topic and talks about different kinds of springs, some powerful spring setups, a little bit more detail, certainly more detail than what we've talked about here, and more. A little more, maybe not sophisticated. Well, yeah, I guess more sophisticated and more in depth, and particularly about when not to take springs. I mean, I gave you a good clue. Not in a downtrend. I mean, that's a clear indication. But I show you in that tutorial that where you can locate the end of a downtrend, that they're very good. So it's more advanced than the fundamentals here. We're just going through the fundamentals, because that was, I don't remember, 2.5, 3 hours worth of stuff just on springs. There was like 50, 60 charts just on springs. It's everything I know about springs. So it's pretty in depth. And I can't do that here, obviously. All right. And you have the upthrust course, so you better get that one too. Yeah, there you go. And the upthrust course is similar. It does that as well. All right. Any other questions before we close it off for tonight? All right. And I would encourage you to do the assignments. I've gotten a couple of good ones, and I've given some people some feedback, I think, some detailed feedback on them. So, I didn't want to include anything from tonight, but we'll try to include people's charts because I wanted to try to get through some material, and we can go back and look at some of those charts. So please do that work and send in your charts. Have a great rest of the week. Have a terrific weekend, and I will see you next Wednesday.